I'm Deborah, founder of Elevation Wealth Partners, and this is the Elevation Market Update. Today, I'm pleased to have Noel Doiron with me from Rowe Price Investments. Noel is a vice president and regional consultant with the firm. She's been with them since 2018. When she lives in Scottsdale, Arizona, and when she isn't working, I think she's running. Noel has completed a whole bunch of marathons and even an ultra marathon. So welcome, Noel. We're excited to have you with us once again.
Thank you, Deborah. Thanks for having me back.
Yeah, firstly, I'd like you just to talk in general about the economy and what's been happening this year so far.
Yeah, absolutely. I'm sure for a lot of us, it's felt like a really good year looking at our investment portfolios that have once again looked pretty strong. And, from an economic standpoint, things are still very good, but they are starting potentially to feel less positive than they have over the past maybe couple of years. But I would say our view at T. Rowe Price is our economy is still good, the stock market is still good, and our view is that we're not going to have a recession in the near term. So a couple of things I'd like to dive into there. From an economic standpoint, if you were not away on a summer trip, which I hope you were, you might have missed a little pullback we had in early August in the market. It was a quick pullback and a quick bounce back. And the main reason for the correction in the market is we got an unemployment print or some unemployment data that was on the margin worse than we have seen previously. So unemployment went to 4.3%, which I'm sure for many of us here who have been around for a while, that still doesn't seem like a really high number. But what we're seeing is that unemployment just slowly, very slowly continues to tick higher. So it's something we're monitoring. However, on the flip side, we've got a lot of positives in the market right now, or in the economy right now. So GDP continues to grow, albeit not at the fastest pace we've ever seen. But one of the things that we noted after the unemployment print, and one of the reasons we didn't panic at T. Rowe, is we had just seen some GDP data from the first quarter. So what typically happens when we get these GDP estimates is they continue to be revised over time as we get more accurate data in. And typically the GDP data is actually revised lower. The growth is revised lower. Well, this time the growth was revised higher. On top of that, when we look at what's feeding into GDP growth, it is largely off the backs of a strong services economy. And that's really important here in the US. Manufacturing absolutely is an important part of our economy, but much more important, and what we're much more reliant here on in the US, is our services economy. So if we were to start to see cracks in the services side of our economy, that's when we would get concerned. But we still have, GDP growth that is strong and it's positive, and we still have services that continues to remain strong in our economy.
So very interesting to hear about some of the details that the firm is tracking to look at the overall picture there and the health of our economy. So as we get closer to the election, how is that impacting the markets?
Yeah, well, I would say that elections, I think, tend to get far more credit than they're actually due for making any sort of impact on the economy. So I'll throw out a few stats. These are unbiased stats, just looking back since 1927 at what's happened in the market during election years and non-election years. So if we look at returns on the S&P 500 during election years versus non-election years, I will admit that election years have a slightly lower S&P return. So if you look at the data, you'll see that during election years, the average return on the S&P 500 is 11%. Still a pretty good return on the S&P 500. Non-election years, 11.5%. So we're not talking about this dramatic divergence in terms of, whether or not we're in an election year. The other thing that I would point out about these years specifically is we have had some major economic events, probably some of the biggest in our country's history during these election years. So 1932, we were in the midst of the Great Depression. 1940 and 1944, both World War II years. 2000, the tech bubble burst. 2008, we had the global financial crisis. And in 2020, we were dealing with COVID. So if you think about those really big market moving events, what we would say is it's not really the election that has the impact on markets. It's more so what's going on in the economy. And, there can be some things we can take away from an election because each candidate, as we know, has different priorities. And so, when we look at the candidates, they're very different on things like energy. There are actually more similarities than you would think in terms of their healthcare views, but there are some differences too. But when we look at, what typically happens in, at what the impact is overall in the markets from a presidential election, what impact they can really have, it's also important to remember that we can still have checks and balances where some of the more extreme policies may not get passed on either side. And I say that because, 2 months ago, Deborah, you and I met and we were still talking about, a Biden versus Trump election. And now, as we all know, things look very different. And so when we were talking about a Biden versus Trump election, I mean, it felt like a foregone conclusion that the Republicans could probably sweep the presidency, the Senate, and the House. Now, that's not such a foregone conclusion. So the base case now is probably that the Republicans win some or something, and the Democrats win some or something. And when that happens, that's best case scenario for the markets, because again, none of those extreme policies get passed that have major impacts on markets and lives.
Yeah, thanks for helping us make a little bit of sense of that. So when we're not worrying about the election, everyone's talking about interest rates. What's going to happen to those high rates that we've been experiencing for quite a long time now?
Yeah, and I know a lot of us have felt this. I moved to Scottsdale 2 years ago, and I'm still trying to buy a house. So we're in the midst of it, feeling it. But it's interest rates, when we kind of go back to what we were just talking about with the election, potentially it's more what is the major market moving event this year if we have one. The Fed and the Federal Reserve, what they're doing, they probably have more of an impact on the market than the election. So this is something that I know we have been paying attention to and will continue to pay attention to. So at the time of the recording of this call here, we are just off of the heels of the Jackson Hole meeting, which is one of the biggest meetings of the year for the Federal Reserve. And Jerome Powell finally, after many, many months, said something that was music to the market's ears, and that was, the time has come. And so the time has come where the Federal Reserve is going to start easing or reducing interest rates. And they moved pretty quickly on the way up because they were coming from zero, right? So we don't necessarily expect them to move as quickly or dramatically on the way down, because right now it's again, almost a foregone conclusion that in September, this month, we're going to see a cut in interest rates, potentially one more this year in December. But now the debate is, okay, are they going to cut by 0.25% or by 0.5%? And our view at T. Rowe is that they tiptoe into this and they kind of feel out how quickly, how slowly they need to do this, because the benefit that they have right now is we are not in a recession. This is not an emergency. They don't really have to get ahead of anything. There is a need to start easing, but it's not an emergency where they have to, put the foot on the gas on the way down. And then the other, debate that folks are having is, how much, when does this end? We would call it the neutral rate. Where does the cutting cycle end, where the Federal Reserve believes the economy can operate for a sustainable period of time. And I think they're going to have to figure that out, because it's certainly not zero and it's certainly not 5.5 or 6%. So we're probably going to be somewhere in the middle there.
Yeah, it will be interesting to see because they've always talked about the 2% number, and I think it's not necessarily considered that is the target for the future. Yeah. So amongst all of this, Noel, T. Rowe Price has to find opportunities for investing our money, our clients' money into companies. So tell us what's on the horizon there.
Yeah, and this is where things get exciting, right? Because I think a reversal in an interest rate policy can open opportunities. Your traditional bonds start doing better, small cap stocks start doing better. But when we look at specific industries that we're excited about at T Rowe, I'm sure that this isn't the first time you all are hearing the words artificial intelligence or the acronym AI, right? But that is an area we continue to be very optimistic about. T. Rowe Price, we have 400 analysts based around the world. And so we were very early entrants into this artificial intelligence theme. And that's allowed us to kind of move in, move out, find different winners there. But we don't think that theme's going away. What we would say is that, this year, there's probably been a little too much euphoria because this is a long trend. This is not coming into, our lives aren't changing tomorrow with artificial intelligence. This is going to happen gradually and slowly over time, but it will be meaningful. And so we have had to take a step back sometimes out of, not completely out of names, but, pulling back from some of our positions that have done really well, like NVIDIA, that's been a big one this year. And so, we're still heavily invested in that trend and in that theme, but we're looking for other opportunities as well. And one of the interesting things that I looked at yesterday is, well, let me start with this. Our view for the next 6 to 18 months is we do see the winners start broadening out, and we'll get into some of those other industries in a moment. But we do start to see a broadening out of markets where it's not just the magnificent seven that are pulling in share. It's going to be other companies as well. And one of the things that I noticed when I logged in to one of my software analytics services on Monday is that if you look at the past month, the top 3 performing sectors in the S&P 500, it's been utilities, it's been real estate, and it's been consumer staples, all value in industries and sectors. You had to go down to number 8 to find technology. So we're already seeing the broadening out of this theme. We don't want to pull away from it completely because it is important, but there's going to be some other winners in this AI theme as well. And so let's move on to some of those. We talk a lot about the need for energy. These data centers that are being built around the country to help store all of this data that we need for artificial intelligence. There's a lot of other things besides just technology that go into those build outs. So we start thinking about how our electrical grid needs to be dramatically improved to make sure that, that all of us on this call continue to have electricity, and that, certainly the data centers start getting electricity too. So one of the things you've seen Amazon do, for example, they've purchased buildings and have started building buildings near nuclear power plants to get easier access to nuclear energy. You're going to see the need for copper wires, copper start to increase. So you're going to have these, I would say, AI corollaries in the energy space that we're paying a lot of attention to, and is probably one of our highest conviction ideas at this time over the next few years. The other interesting thing we're looking at, again, kind of a corollary to AI or big data, is precision agriculture, which is pretty interesting. You don't often talk about agriculture on these calls, but precision agriculture uses this big data and analytics, and they essentially it's looking at demand, right? So then that allows farmers to focus on the right crops that are in demand, so they're not overproducing, they're not underproducing. And so it kind of gets everyone on the same page, the consumers, us who are consuming the crops, and then the farmers who are helping us grow the crops, and aligns so we don't have to have waste of food or waste of money either. And then I would say the last area that we've been really excited about for a few years now is just healthcare in general. There's a lot to be, I know it doesn't often, no one really wants to go to the doctor, but there's a lot from an investment standpoint to be excited about with healthcare. We do have an aging population in the US with a lot of baby boomers who are reaching the age where they, need more healthcare. And so, there's that side of it. But then the more exciting side of it, and I think the more, fulfilling side of it, to kind of end this section on a positive note, is there's a lot of amazing innovation in treatments and drugs. And these innovations, they're going to prolong life, but not just to, prolong a life. It's going to prolong life and ensure a quality of life as it's prolonging that life. So there's a lot to be excited about, as investors and as human beings in the healthcare space.
Well, and it's great to know that T. Rowe Price has so many people that are really looking in detail into all of these things and finding great opportunities to put it into the funds that we invest in. So some great information there. We're getting to our time. So what would you like to say to wrap up?
Yeah, I think the most important thing is to recognize that we are in and will continue to be in what I would call a headline heavy environment. We're in an election year, in the last few months of the election. So, I don't know about you, but when I turn on the TV, there's ads, there's, talking points, we're seeing rallies all over the place. There's a lot going on from an election standpoint. And a lot of, what's happened in our modern election process is there's a lot of fear that goes along with that, right? Each candidate, the media trying to instigate some fear to get you to act or do something. So there's those headlines. We've definitely got the Federal Reserve in play now, which is a good thing. And we've got a stock market that has been really strong as well. So any negative, pinpoint that the media can put on the stock market, they will, to draw you in. So just beware of the headlines. The headlines do not make or break the market over certainly the long term, and most of the time not even the short term either. So what I would caution you is just beware that the headlines are out there. If you're on this call, you're already doing the right thing, right? You're working with, Deborah and her team, and you're invested in a diversified portfolio. And a diversified portfolio allows you to capitalize on some of the opportunities that I talked about, and it allows you to mitigate some of the risks that will actually be out there. So beware of the headlines, but just stay the course.
Yeah, the headlines just give us plenty to talk about, don't they?
They sure do.
Noel, thanks for being with us today. We appreciate all this great information. To our viewers, if you have any questions about what you've just heard, feel free to reach out to us at Elevation, phone, email. We'll be happy to talk with you. Otherwise, we'll be recording it again later in the fall. Thank you.